What's up, everyone? It's Brand the Mortgage Man, and if you've watched any of my videos on this YouTube channel, you already know I've been doing this 22 years. You know I've helped tens of thousands of people with their mortgages for billions of dollars in loans. But does that really matter to you? Probably not. What really matters is if you're looking to buy a home, well, what are the best ways to save some money when you're purchasing that home? So what I'm gonna do, I'm gonna treat you just like I treat any of my clients. I'm actually gonna show you the 3 best ways to save on your monthly payments when you're purchasing a home. So let's get right into that. So the first way that you can save when you're purchasing your home is with a discount point, right? Paying a discount point means you're paying 1% of whatever your loan amount is to reduce your interest rate permanently. So let me show you what this looks like. So let's just say that the current market rate was 7% for a 30-year fixed rate mortgage, and you want a lower interest rate. Maybe you want something at 6.5% for the life of the loan. Well, in order to do that, you're gonna have to pay. And when you pay, that's called paying discount points. And as I mentioned, 1 point equals 1% of your loan amount. So if you're borrowing $300,000 and you're paying 1 point, well, that means you're gonna be paying $3,000 for this 1 point, right? It's the 1% of your loan amount, or 1%. So this is paid as part of your closing costs and is used to reduce your interest rate, as I mentioned, permanently. And the reason I keep bringing that up is because I'm going to be comparing this to a temporary interest rate buy down as one of the other ways to reduce your payment. I want you to really know the difference. So if you're reducing your interest rate by 0.5% permanently, and let's say you are borrowing $300,000 for this example, I'm going to show you the difference in your monthly payment. And I wish I had this memorized, but I'm not that good. So we're just going to use a mortgage calculator. I'm going to keep this really simple. $300,000 loan amount, 30-year term, 7% interest. So our payment of this is only principal and interest, because keep in mind, there are other pieces of your monthly payment that you're gonna have to worry about, such as mortgage insurance if you're putting less than 20% down, property taxes, homeowners insurance, and an HOA fee if you are buying in a homeowners association. But for now, the savings and the difference in the payment is really gonna be on the principal and interest only. Those other variables will be the same regardless of what your interest rate is. So now let's compare this to $300,000 over 30 years at 6.5%, your bought down interest rate, right? So we're saying that this is going to be $1,896.20. So what's the difference between these two payments? We're talking about what? Around $100 a month, right? Savings. So you're going to save $100 every single month at a cost of $3,000. So we know the cost is $3,000, which is your point, and you're going to save $100. Right? And we come up with 30. This number represents the number of months for you to break even on this cost based on your savings. So when it comes to paying a point or you can pay more than one if you want to reduce your rate even further, and there's no set amount that it reduces your rate. I'm just giving you an example that it could reduce your interest rate by 0.5%, but it depends on the market. It could be 0.25%, it could be 1/8%, right? This is strictly for you to see what this would look like. It could be a general idea of what a discount point can do. Now, we said it takes 30 months, which represents the number of months it will take you based on $100 per month savings to recoup the $3,000 that you paid in advance as part of your closing costs. Now, what's the benefit of this? Well, let's figure this out. We said it's 30 months. That on a 360-month mortgage, which is a 30-year mortgage, you're saving for the remaining 330 months, right? So to figure out what this actually saves you over the term of the loan is we take the remaining months after we subtract the 30, right? So we 360 months in a 30-year mortgage minus the 30 months that it takes you to recoup this money. That's gonna leave 330 months. So we take 330, we multiply that by the savings, which is $100 a month, right? That's what it reduced your payment by, and that's gonna equal $33,000. So if you kept this mortgage for the full 30 years, in this example, you bought the rate down, it saved you 0.5% on your rate, which saved you $100 per month on your payment. It would actually save you $33,000 over 30 years by paying that discount point. So you may have heard, oh, never pay discount points. Well, I don't know why anyone would tell you that, because it truly does save you money. Now, here's another added benefit to paying discount points, because maybe you decide, hey, I'm not keeping my loan for 30 months, and therefore it doesn't make sense for me to pay the discount point, which could be true. However, you may need the lower interest rate in order to qualify for the mortgage. And the only way to do that may be with paying the discount point. So keep that in mind. Now, the second way that you can reduce your monthly payment is you can do a temporary interest rate buy down. Now, I mentioned permanent, right, on the points because it buys the rate down for the life of the loan, which would be considered permanent, right? However, there's an alternative to paying a point, and that is a temporary rate buy down. So I'm going to call that TRB, temporary rate buy down. And there's different types of temporary interest rate buy downs. So you can have a 1.0, you can have a 1.1, you can have a 2.1, you can have a 3.2.1. And so just so you have an idea, a 1.0 temporary interest rate buy down means that your interest rate is reduced by 1% for the first year of your mortgage. A 1.1 temporary interest rate buy down means that your interest rate is reduced by 1% for year 1 and year 2. A 2.1 temporary interest rate buy down means it's reduced by 2% the first year, 1% the second year. And then a 3.2.1 interest rate buy down is reduced by 3% the first year, 2% the second year, 1% the third year. So the most savings is going to be with a 3.2.1 buy down, but these all come with a cost. The same way it was discount point to reduce the interest rate on the permanent rate buy down, a temporary rate buy down cost is based on the savings. So if you're saving $10,000 over, let's just say 2 years with a 2.1 buy down, temporary rate buy down, it would actually cost $10,000 for that 2.1 temporary rate buy down, meaning that the cost, I'm just going to call it 10,000, equals the savings. Call that the same 10,000, right? Cost equals savings. So you may say to yourself, why would I spend $10,000 to save $10,000? I'm not really saving anything. I'm really just moving the money from one place to the other. And I agree with you. So when it comes to temporary interest rate buy downs, although they will save you the most amount of money in the short term, and they're a great way to reduce your monthly payment, they only make sense when they're being paid for by someone other than you as the borrower. Because as I said, if the cost equals the savings, you're not really saving anything. So you're not just going to pay the money to pay the money. It's like me taking this calculator, moving it from my left hand to my right hand. It's still my calculator, right? Nothing changed just because it changed hands. Same concept. So what you would do in a situation like this is you would want to try to get the lender or the seller of the property to contribute toward that cost for this temporary rate buy down. So that's going to be extremely important if this is something you're considering. And the monthly savings could be substantial with this type of rate buy down. Now, that was option 2. Option 3, not necessarily going to save you any money, but it is a way to reduce your monthly payment, which is what we're talking about here, right? So the last thing that you can do, you can actually waive your escrow. Now, what are escrows? Escrows, when it comes to a mortgage, are the property taxes plus the homeowner's insurance that would be included in your monthly payments. So a mortgage payment is comprised of a few things. It's the mortgage, which is principal and interest. If you put less than 20% down, it's mortgage insurance or PMI. And then it's property taxes and homeowner's insurance. So you may have heard the term PITI, right? Stands for principal, interest, taxes, insurance. And insurance in this situation represents homeowner's insurance and mortgage insurance if you're putting less than 20% down, as I said. However, you actually have the option of only making your mortgage payment PI, right? And then if you have mortgage insurance, technically it would be plus mortgage insurance. If you're not paying mortgage insurance, then it would just be PI. You do not have to include the TI in your monthly payment. So let's just say that your principal and interest portion of your payment was going to be $1,500. You have mortgage insurance of $80. You have taxes of $300. And then you have homeowner's insurance of $150. You can take your taxes and your insurance, right, which you're saying is $450 in this example, keep it separate from your mortgage, and only have your mortgage payment comprised of this $2,300. Now, you still have to pay your taxes and insurance. There's no way around that. I have to pay my taxes and insurance, right? However, maybe you have an income that's variable, right? Maybe it's commission or bonus-based, where it fluctuates from one month to the other, or you're self-employed, and there's no real determining how much you're going to make each month. You know, in general what you make in a year, and you have no problem budgeting and having funds available to pay your taxes and your insurance once per year when they're due. But maybe on a monthly basis, it's easier for you to work with the lower monthly payment. Well, waiving escrow is a great way to do that. Now, most lenders, I'm not going to say all because we allow you to waive escrow with only 3% down, but most lenders will require you to put 20% down in order to waive escrow. If you're getting an FHA mortgage, you will not have the option to do that. And if you're getting a VA mortgage, we also allow you to waive escrow. Not all lenders do. So the important thing to do with any of these three options that I mentioned is to make sure you speak with your lender and see if they even offer these options for you, because not all of them will. And you don't want to base your decision around something that you can't actually accomplish with the lender that you're working with. But if you're going to waive escrow, it's a great way for you to reduce your overall monthly payment. And it's also going to reduce the amount of money you need to bring to the closing table on top of that. Now, you can actually combine all three of these. You don't have to just pick one. So you can permanently buy your rate down, meaning like we talked about before, 7% down to 6.5% as your example. If you did that, and then you also did a temporary rate buy down for 2 years, that means your rate would drop to 4.5% the first year, 5.5% the second year, and eventually go to the 6.5%. And you can waive escrow on top of that. So if you're combining all three, you're gonna have a much lower monthly payment than if you didn't use any of these options. And here's something you wanna consider. The seller of the property you're buying can actually contribute. It's called a seller credit or seller concessions. And check out my videos on that specifically if you want more information. But they can actually contribute and cover the cost of those things. So there's no cost to waive escrow typically. There is a cost to buy the rate down permanently, as we talked about. That's the discount point or discount points. And the temporary rate buy down is a cost equal to the savings, as we said. But if the seller's paying for those things, it's free to you and it's just all savings. So it's important for you to coordinate with your lender and with your realtor when it comes time to submit offers on properties, because if you want to take advantage of any of these things, it's something that you want to build into the offer that you're making on the property. If you want to watch more detailed videos on ways to save money on your monthly payments, make sure to check out the video in this link. And if you want to learn more about buying homes and just mortgage education in general, make sure to follow Brand the Mortgage Man on YouTube.